Today is Tuesday, February 23rd, and this is a post-market review for the stock market activities today. The main event of the day was the testimony of the Federal Reserve Chairman Jerome Powell. The markets opened significantly lower in the morning, awaiting words from the Federal Reserve Chairman to calm down fears regarding inflation. And of course, we could give Jerome credit for the day that he did the job and the indices managed to close well above the lows of the day. Whether the rescue operation will stick and the markets will trade higher from here, that remains to be seen. Whether Jerome Powell was successful in easing inflationary concerns once and for all, or was it just a one-day wonder? And of course, the Federal Reserve Chairman, who is absolutely delusional and out of touch, his approach to resolve the matter today was as expected. Lies, deceptions, and more lies. When confronted with the fact that Treasury yields are rising higher, impulsively higher, matter of fact, Jerome Powell brushed all concerns aside, saying the yields are rising for the right reasons because we have an economy that is recovering rapidly and we are heading into an era of tremendous economic growth, and all there is in the rise in Treasury yields is expectations of a phenomenal growth in the future. But when Jerome was also confronted about the bonds purchasing program, aka the cocaine supply from the monetary policy into the markets, creating asset prices to reach extreme valuations. When the chairman was confronted with that and asked, isn't it time to taper the bond purchasing program, since you yourself, Mr. Jerome Powell, just said that the economic growth picture is rosy in the near future? The chairman responded by flipping 180 and saying, oh no, but the economy is still not out of the woods yet. We still have over 10% unemployment rate and the economy is in dire and desperate need of aid from the monetary policy. So which one is it, Mr. Jerome Powell? Is it that we have an economy that is recovering faster and better than expected? Or is it that we have an economy that is still under threat and is in dire need of fiscal and monetary stimulus? But regardless, even if inflation rises higher and faster than expected and we reach an overheated state of the economy, Jerome Powell calmed down the markets by assuring us that the Federal Reserve has the tools of combating any unwanted rise of inflation, and that we are not heading in a scenario just like we saw back in the 1970s. More lies and more deceptions, as expected from the Federal Reserve Chairman. We will discuss that and a lot more during the headlines of the day segment. But for now, we do have a market to cover, and here we go. The Dow Industrial Average closing in the green by 15.66 points, or a gain of 0.5%. The Nasdaq in the red, down by 67.85 points, or a decline of half a percentage point. The S&P 500 closing in the green by 4.87 points, or a gain of 0.13%. And as you can see, the indices started significantly lower and started to pick up steam from dip buyers as long as Jerome Powell offered assurances. Whether these assurances will remain warranted for the next few days and weeks, that remains to be seen, but the trick worked for the day. And what about the sector's performance for the day? Energy coming up at number 1 and capturing the gold medal, and at number 2 for the silver. Utilities at number 3 for the bronze medal. Communication services. The laggards of the day led by technology, healthcare, and consumer cyclicals. The inflationary trade remains in charge here, led by the energy sector and an outperformance from financials, industrials, and materials. What about the futures market performance for the day? Another day of gains for crude oil, and the trajectory seems higher, as we discussed yesterday, from the research out of Goldman Sachs expecting crude oil prices to trade at the levels of $75 a barrel by the second half of the year. And that could perhaps happen a lot sooner than that, given the trajectory and the rapid rise of crude oil prices the last few weeks. What about softs? Significant gains for coffee, followed by OJ, coca, and cotton. The laggards of the day led by sugar, and we saw sizable declines here for lumber. What about metals? The inflation in copper goes on, copper closing yet another day of gains of about 1.5 percentage point. Muted activities for gold, but we saw retreats in silver, platinum, and palladium futures. What about meats? A resumption of the gains for lean hogs. Meanwhile, we saw losses for live cattle and feeder cattle futures. Moving on to grains. Decent day across the board, and we saw sizable gains here of more than 3 percentage points for canola and oats. Meanwhile, soybean oil closing a little over 2% gains. And we saw also soybean meal, soybeans, corn, and wheat futures closing in the green. The laggard of the day led by rough rice futures closing slightly in the red. All in all, while the equities market took comfort in the words aka the lies of Jerome Powell's testimony, the futures market remains unmoved one way or the other by whatever came out of Jerome Powell's mouth. The trajectory for the futures market and commodities remains higher. Moving on to the options market, aka the big casino. We saw a slight uptick of activities across the board, and the tables were a little hotter than yesterday. Leading the pack at number 1, Apple, with about 2 million contracts exchanging hands today. About 69.5% of those were calls. At number 2, Tesla, with about 900,000 contracts. About 55% of those were calls. And number 3, AMC, with about 800,000 contracts traded today. About 79.5% of those were calls. Lots of dip buying, specifically in the high momentum names via call options. And what about the unusual trades that took place in the options market today? Here's a trade for the ticker XLE. This is for the energy ETF. Somebody's betting on more gains to come here for the energy sector by buying the 54 calls expiration date May 21st with expectation that the energy ETF will rise over 11% by then, and they paid about $1.60 a piece to enter this trade, and that brought the total all the way to about $3.5 million. Here's another illustration for the dip buying in the high momentum names that got whacked significantly during this correction. For the ticker PLUG, this is for Plug Power. Somebody's betting on a rebound here by buying the 56 calls expiration date March 19th with expectation that Plug Power would rise over 19% by then, and they paid about $2.50 a piece to enter this trade, bringing the total to about $4.5 million. Here's another interesting trade for the ticker LFMD. This is for Conversion Labs. And this is again one of the hot momentum names that got whacked significantly during the last few days. And once again, they're betting on a bounce here by buying the 25 calls, expiration date April 16th, with expectation that the name is going to rise over 14.5% by then. And they paid about $5.70 a piece to enter this trade, bringing the total to about $6 million. Here's another one for the ticker ARKK. This is for the ETF for ARK Invest by Kathy Wood. Once again, playing a rebound by buying the 147 calls expiration date this upcoming Friday, with expectation that ARK would rise over 5.5% by then, and they paid about 70 cents a piece to enter this trade. All in all, they paid about $600,000 to enter this trade. We're seeing the same theme here repeating itself in the options market. Lots of fear regarding these high momentum, high growth names. We saw a sell-off the last few days due to the fears of inflation and the rise of treasury yields, which in turn will make these names less and less attractive. But after the assurances from Jerome Powell, at least for today, traders are playing rebound. The options market is showing you the psychology and the sentiment of market participants today, and they are saying what Jerome said is enough and we are back into risk-on mode. Whether this is misguided or not, we shall see. Continuing with interesting trades. Here's a very interesting one for the ticker SQQQ. This is the inverse index of the Nasdaq, the triple Qs, meaning that somebody's making a bearish bet against the technology sector. Here comes the contrarian view. That yes, we saw a rebound today, but it is a dead cat bounce. In this case, they're buying $15, or they're buying calls for the $15 strike price in the SQQQs, betting on more declines for the Nasdaq. And in this case, they're betting that the inverse index would rise over 11% by the expiration date of March 26, and they paid about 95 cents a piece to enter this trade, bringing the total to about $500,000. Here's another interesting trade for the ticker FCX, Freeport McMoran. Massive rise higher for this name, but somebody's bidding on a retreat here for Freeport McMoran, and perhaps during that retreat we will see it inflow back into the Nasdaq and the riskiest names. This could be the upcoming theme depending on how sticky the assurances from Jerome Powell's testimony will be in the market. But in this case, somebody's buying the 33.5 puts for Freeport McMoran, expiring March 19th, with expectation that the name is going to decline over 11.5% by then, and they paid about 70 cents a piece to enter this trade, which brought the total to about $400,000. Here's a very big trade for NVIDIA, the ticker NVDA. They're making a bullish bet by buying the 660 calls, expiration date March 19th, with expectation that the name is going to rally over 16.5% by then, and they paid about $4.70 a piece to enter this trade. That brought the total all the way to over $2.5 million. Here's another one, very interesting one for the ticker ARKK. Once again, we saw the bullish trade earlier. Now we have to talk about the bearish trade against Cathie Wood ETF. And of course, if we have not seen the end of this correction, and we are just witnessing a dead cat bounce, that means that it is an opportunity to short the ARKK because it is the poster boy for this correction, with very risky names and high concentration of ownership by one firm. Because for this trade, they're buying the 125 puts, expiration date April 16th, with expectation that Cathie Wood ETF will decline over 10%, and they paid about $6 a piece to enter this trade, which brought the total all the way to over $3 million. Moving on to the headlines that shaped the day, starting with macro news. We received an update for the savings rate. Here it is. Savings rate has ticked down from a massive spike during the pandemic, likely to go back up soon courtesy of further fiscal aid. But despite that, savings still account for more than 10% of the nominal GDP. And once again, another round of stimulus will add more to the saving rates, and in turn, that will add more to the pinned-up demand that is about to be unleashed into the economy once the reopening phase is officially started. Jerome keeps denying the fact that inflation would rise from the sudden surge of demand and spending all at once in the economy. But once again, Jerome weaseled his way out of that by saying that the inflation could happen, but it will be just a temporary reaction, and that the de-inflationary pressures are a lot stronger. And of course, none of the ranking members asked Jerome Powell how would the de-inflationary pressures find more copper for us and extract it faster than we can right now, because the demand is exceeding the supply, and I'll illustrate that for you just in a little bit, not just in copper, but in many other industries. More in macro news, the U.S. consumer confidence improved while house prices surged higher. Once again, another indicator that the inflationary pressure is higher, not lower. Give people more stimulus, announce more stimulus, and they will be highly confident to spend like drunken sailors once the economy reopens. The conference board said its customer confidence index rose to a reading of 91.3 this month from the prior reading of 88.9 in January. Economists polled by Reuters had forecasted the index nudging up to a reading of 90, so the reading we got is a lot better than the expectations. But of course, the cutoff date for the survey was February 11th, so it did not capture the winter storm that knocked out electric power in Texas or the easing of dining restrictions in New York City. We know that the recovery is underway in Texas, and I'm assuming that consumer confidence will continue to rise higher and higher so long as we have more promises of more stimulus. But here's what happens when you usher the tsunami of liquidity all over the economy. You will create excesses. Those excesses will go into buying stocks, buying real estate, buying commodities, buying more goods, and saving in accounts awaiting for the reopening of the economy to do more spending. The money supply is here. The velocity of money is not here yet. And this is what we are starting to see, and therefore you are seeing a tick higher for inflation. But what about the supply chain? Can it keep up with all of that demand coming up from the tsunami of liquidity? Here's the article by the Wall Street Journal. Consumer demand snaps back. Factories cannot keep up. Snarl supply chains, labor shortage, thwart full reopening. Everyone was caught flat-footed. U.S. manufacturers aced the shutdown of their factories and warehouses last spring in response of COVID-19. They are botching the recovery after carrying out an orderly retreat from assembly lines. As the pandemic arrived in the U.S., many manufacturers pulled out the playbook they followed in the past recessions, cutting costs and preserving cash. That left them unprepared for the sharp rebound in consumer demand that began just weeks later and never let up. And as you can see from the chart, personal consumption is a lot higher than industrial production. And at some point, industrial production will be able to catch up with the demand. So you might ask, well, what is the concern here regarding inflationary pressures if the supply will manage over time to keep up with demand? If you are asking this question, then you have not been paying attention to what's been going on. We do have an uneven recovery, the largest wealth inequality gap in history. The tsunami of liquidity found its way floating higher to the haves and corporate America. A lot of that money went into the stock market, creating excesses and bubble-like pricing. But the bottom half of Americans and a lot of small businesses are in a state of destruction. A lot of small businesses in New York City are never coming back. So will a lot of businesses in California and other territories shut down permanently, and they will not be coming back. In addition to the fact that corporations figured out how to do more with less, and they don't need more employees even after the reopening phase. In addition to all the missed rents, bills, credit card payments from the have-nots, and that will leave them in a worse situation than they were in during the pandemic without any more fiscal help and stimulus. The uneven recovery on one side, the half sides, will create massive inflation higher due to the high savings rate, the high disposable income, the high stock market portfolios. All of that will be unleashed into spending in the economy, creating inflationary pressures higher. But the half of America that is being left behind will trail the recovery and will not be able to catch up. And we are not talking about 5-10% of the population. We're talking about a number over 30% of Americans who are still technically struggling from income losses from the pandemic, let alone the struggles of small businesses. The gap in the recovery by creating high inflation on one side, meanwhile a lagging recovery for the other half, will not create a balancing effect as you might have imagined, but it will actually create more and more inflationary pressure. And the reason is we know that the federal government and the Federal Reserve will not take their foot off the pedal until, quote-unquote, they see full recovery in unemployment. Well, that recovery is not going to happen voluntarily because certain sectors in the economy haven't recovered yet and will take a lot longer to recover. We're talking about small businesses. Furthermore, as I said, lots of corporations figured out to do more with less. In addition to the fact that a lot of employees, or potential employees in this case, are more comfortable staying at home collecting aid from the government rather than working, and therefore to incentivize hiring in the economy, specifically in the retail sector, wages will have to go higher, creating more and more inflationary pressures. And since the Federal Reserve still measures inflation based on the bullshit formula, the CPI and the PPI, ignoring actual inflation that is impacting the average American household in terms of food, gasoline prices, rent, etc. The weighting of the formula that the Federal Reserve uses can be tilted very easily. One of those factors are real estate prices, specifically in certain markets, in this case the New York market. We know how weak this market has been the last few months, but here is the turnaround. Manhattan luxury market notches the strongest 3-week streak in 6 years. 36 homes priced at least $4 million went into contract last week, according to Allshan Realty. There is no escape from higher inflation one way or the other, whether we're talking about real estate, equity prices, commodity prices, average household expenses prices, all trending higher. But the Federal Reserve remains in denial and remains confident that any inflationary pressure will just be temporary. Jerome Powell, as we'll show you later, says that he does not want to repeat the mistakes from the 1970s. One of the mistakes in the 1970s was not paying attention to the rise of inflation and brushing everything off as it's only temporary. And here is Jerome Powell. Janet Yellen and Jerome Powell both appear wary of signs of froth in financial markets, even as they press ahead with economic stimulus. Look at the froth that we currently have all across the board, even without the new round of stimulus. What will happen when we add more fuel to the fire? It doesn't take a genius to figure that out. But here was Jerome Powell when he was asked about the rise of the 10-year Treasury yield. Here comes the art of deception.
We look at the whole range of financial conditions. And it's very important to ask, why are rates moving up? And so if you look at why they're moving up, it's to do with expectations of a return to more normal levels, more mandate-consistent levels of inflation, higher growth, an opening economy. In a way, it's a statement of confidence on the part of markets that we will have a robust and ultimately complete recovery. So those are the reasons that are behind it.
All right, keep that in mind. Jerome said that the economy is heading for a fantastic recovery, and this is the reason behind the rise in Treasury yields. Now watch his response when he is asked regarding tapering the bond purchasing program.
But to address monetary policy for a moment or so, I think the Fed's current forecast for growth for this year is over 4%. I think the consensus is well over 5%, with some thinking it could be considerably higher than that. The unemployment rate is now at 6.3, which is about where it was in 2014 when we were not contemplating multi-trillion-dollar bills. And I don't think we were buying $120 billion worth of securities per month. My concern is that the last two recessions were, I think, caused by asset bubbles that burst. 2001, it was the stock market. 2008, it was the mortgage credit market. In both cases, in my view, monetary policy contributed a great deal to the formation of those bubbles. The Dallas Fed president, Robert Kaplan, recently acknowledged that there's a link between the record amount of liquidity being pushed into the system and these unprecedented asset valuations that we're seeing in a whole range of assets, be it GameStop or Bitcoin or real estate, commodities. Across the board, we're seeing quite elevated asset prices and signs of emerging inflation. So I guess my question is, do you believe that there is a link between the liquidity that the Fed has been providing and some of these unprecedented asset prices?
So there's certainly a link. I would say, though, that if you look at what the market is looking at, what markets are looking at, it's a reopening economy with vaccination, it's fiscal stimulus, it's highly accommodative monetary policy, it's savings accumulated on people's balance sheets, it's expectations of much higher corporate profits, which matters a lot for the equity market. So there are many factors that are contributing to what's happening in markets right now. Monetary policy, I would certainly agree is one of them.
Yeah, I would just suggest that, right, I agree. All of those things are happening. All of those indicators of growth and increasingly indicators of rising inflation. As you know, the TIPS 10-year break even on inflation is now over 2%, up from 0.6%. My point is that at some point, we've got too much liquidity going into the system. The economy is recovering very, very well. Problems are isolated and should be addressed narrowly. And I hope that $120 billion a month of bond buying doesn't become a permanent situation. One of the things I'm concerned about, I wonder if you could comment on the risk that we would have an increase in inflation, an increase in bond yields that would correspond to that, but without being back at full employment.
And look at how confused Jerome Powell is. He got caught with a good one. This guy asked him an excellent question. First, he trapped him with his own words by asking about the excessive valuations in the stock market. Now that Jerome Powell confirmed that asset prices are rising higher due to expectations of an economy that is recovering rapidly. And of course, he does not deny that monetary policy is contributing to those expectations. And he does not deny, as a matter of fact, asserts the fact that the economy is recovering and will continue to recover in a fashion that exceeds expectations. Now with this statement, the same gentleman is asking him a very important question. If you are saying that the economy is going to recover tremendously, then why do we need more and more liquidity? Why do we need more and more cocaine into the market? Isn't it time to taper the bond purchasing program? And let's see how Jerome Powell will bullshit his way out of this one.
What would that imply, which I think is a very plausible scenario for later this year? What does that imply for the bond buying program?
Well, so what we said about the bond buying program is that it will continue at the current pace, at least at the current pace, until we make substantial further progress toward our goals. And we've also said that as we monitor that progress, we'll communicate well in advance of any actual decisions. Purchases.
And of course, that noise that you heard, that alarm, that was the bullshit detector flashing red as soon as Jerome Powell finished his statement. Listen to what he's saying. He's saying equity prices are at extreme high valuations, but they are supported with the fact that the economy is going to recover much better than expected. But he also says that we are not removing the monetary cocaine support out of the market until, quote unquote, our goals are achieved. What are our goals, Mr. Powell? Somebody please ask him the question. Because if the goal is recovering unemployment, that is not going to happen anytime soon. You can throw trillions of dollars on that problem and it will not solve it whatsoever, for reasons that I have discussed earlier. And he is saying that at some point when the economy recovers and we achieve our quote-unquote goals, we will be prepared to remove the monetary support out of the market by tapering the bond purchasing program. In other ways, Jerome is telling you, don't worry, don't be concerned, continue to gamble in the casino because the party's not over yet until I say it's over. And if it is over, don't worry. I will tell you ahead of time when are you supposed to take your chips out of the table. Ask yourself a question. Are you that stupid? Because the inevitable outcome of this current rally is that it will crash down and the market will suffer a withdrawal. And some of those prices at the highs you will never see again, at least for a very, very long time. Once the support is removed out of the market, meaning that Jerome is the dealer at the blackjack table. He is showing an ace. He is asking us to double down, and he is not offering any insurance whatsoever. What happens if inflation rises higher than expected and stronger than expected, overheating the economy and forcing the Federal Reserve to taper the bond purchases against their wishes earlier than expected? Do you have an insurance against that, Mr. Jerome Powell? Of course not. As the Big Short said, dancing on the edge of a knife. Here was more bullshit from Jerome Powell.
A couple of things. One, first, as the very low readings of last March and April drop out of the 12-month calculation as we move forward this year, we expect readings on inflation to move up. That's called base effects. That'll be a temporary effect and it won't really signal anything. More importantly, though, with all the factors we've been discussing, you could see spending pick up pretty substantially in the second half of the year. And that would be a good thing, of course, but it could also put upward pressure on prices.
Here comes the but part.
And I would just say that essentially it doesn't seem likely that would result in very large increases or that they would be persistent. We've all been living in a world for a quarter of a century and more where all of the pressures were disinflationary, pushing downward on inflation. We've averaged less than 2% inflation for more than the last 25 years. Inflation dynamics do change over time, but they don't change on a dime.
Okay, it's not a dime, Dumbo. It's over $7 trillion in money supply that flooded the market all at once. That is the difference than before. But Jerome continues to deny he never even bothered to mention the massive surge in money supply. He's just betting that you are stupid enough to believe him.
And so we don't really see how a burst of fiscal support or spending that doesn't last for many years would actually change those inflation dynamics. I will also say there's forecasters need to be humble and have a great deal to be humble about, frankly. But so if it does turn out that unwanted inflation pressures arise and they're persistent, then we have the tools to deal with that, and we will.
Okay, here he comes with the tools. I got the tools. We got the tools for everything. I'm just gonna have my plumbing bag and I'll fix it, no problem. Papa Jerome has a magic wand to kill inflation. We will see how that one works. And as the testimony progressed, we heard more stunning revelations from Jerome Powell and statements that illustrates how delusional and out of touch this man is. And of course, don't count on your beloved politicians to ask Jerome Powell the hard questions. They're asking him about climate change and the virus, wealth inequality, racial inequality, and on and on and on. But here are some interesting statements from Jerome Powell. Asked if the 2021 growth could be in the 6% range, he said, could be, maybe, however, somehow, shall be. Who knows? Could be 6%, could be 7%, could be 5%. We don't know. Just sit your ass on the table and give me your cash and let's play some blackjack. Powell says there is a link between Fed liquidity and asset prices. Oh, you think? Powell, no intention of repeating inflation mistakes of the 1970s. Yeah, no intentions, but if it happens, we just effed up. It wasn't our intentions. Don't blame us for your misery, you average bum American. We didn't intend it for your misery. We were just experimenting with some economic solutions. And the experiment went wrong, but it's all good. Look at the bright side. The rich has gotten richer. And here's Jerome Powell. Powell says he's worried about echoes of the pandemic developing possibly next winter. What is he, a doctor? And here's a good question from Jim Bianco. Powell says, don't see spending rise having lasting inflation impact. Powell caveated with, we don't see how a burst of fiscal support will have a lasting effect unless it lasted for several years. And the question here is for Jerome Powell, if we have no inflation, why wouldn't fiscal support last for years? Why don't we have a universal basic income? Why don't we just stop paying taxes and working all together? Why not just give people a universal income every single month since we don't have inflation? Since spending like a drunken sailor from the fiscal and monetary side have no negative consequences or impacts whatsoever, what is stopping the government from just giving us a UBI or even free healthcare, free homes, free cars, free whatever, printed out of thin air? Because more money supply, apparently according to Jerome Powell, doesn't translate in high inflation. Jerome Powell is saying, don't worry, don't be alarmed, don't be concerned. You might feel a little obese, but you are just bloated. Continue to eat donuts, fries, burgers, pizzas, 10 tubs of ice cream every day. You'll be just fine. You'll actually lose weight this way. Here is more from Powell. Powell says inflation is soft. You know what is soft, Mr. Powell? Oh yeah. And the Fed is committed to current policy stance. This is the biggest propagandist, the biggest maniac for engineering the financial destruction of the United States of America, and he is not even an elected official. Who the hell does he think he is? Moving on to market sentiment news, starting with the 21st century's tulip mania. And the 21st century's tulip mania is facing a little bit of technical difficulties. Cryptocurrency exchange, whatever that is, has temporarily suspended withdrawals of Ethereum and Ethereum-based tokens due to high network congestion. Tweet. Cryptocurrency, Tether and Exchange, Bitfinex have agreed to pay $18.5 million penalty after being accused of covering up massive financial losses. The settlement follows a high-profile investigation in the U.S. concerning the cryptocurrency sector. The more you hear about this, the more regulatory action you will see against cryptocurrencies. And Jerome Powell, in his testimony today, acknowledged that the Federal Reserve is working on a digital dollar, whatever that means. I thought that the money or the US dollar is already being printed digitally. When I go to the store and I pay with my credit card, there is no money actually exchanged. Everything is done digitally. So what is the difference here of taking the US dollar digitally? It's already existing digitally. And what's going on with the souffle as a result of the declines that we saw today in Bitcoin? Tesla's share price is now directly tied to the value of Bitcoin analyst warrants. We saw Tesla down significantly in the morning by the tune of over 8%. And remember that the stock was down 8% or so yesterday. Massive declines for Tesla in 2 days. But we saw the rescue from Tesla witch Cathie Woods, who announced on Bloomberg Radio that she's buying more of Tesla at these valuations. The ARK story will end up in everyone involved being drowned to death. Here's more from the souffle. Tesla shares sink in pre-market trading, plunging below the level at which the company entered the S&P 500 in December. And of course, now that the Treasury Department is coming after Bitcoin, Reverend Elon Musk, the pumper-in-chief, is nowhere to be found. I would not even be surprised if he already dumped his Bitcoin holdings. And here's a proof that you don't have to be a genius to be a rocket scientist. You can be a total dumbass, a financial illiterate person, and also become a rocket scientist. MicroStrategy CEO says Bitcoin will one day have a $100 trillion market value even as prices dives. And when the gentleman was asked, "What is your source for this statement, sir?" he responded by, "It's coming out of Uranus. Bitcoin is going to flip gold, and then it is going to subsum the entire gold market cap." Michael Saylor says its volatility will begin to decrease once it hits 10 trillion, he adds. He's just throwing numbers out of thin air. He has no clue what he's talking about. This guy, if you're investing with this guy in MicroStrategy, you better have some sort of an insurance policy, because even my 12 years old nephew can figure this out better than this rocket scientist donkey. More in sentiment news. What about the foreign inflow into the stock market? You know, it's not just zombies and Robin Hodiots who are pushing the market higher. It's also coming from international zombies who are investing in American stocks, specifically the most speculative stocks, gambling all what they have in hopes and dreams that the lottery ticket will pay off. And we know what happens when the lottery ticket doesn't pay off, just as in the case of GameStop stock. Foreign investment in the US equities in the past 12 months reached the highest level ever. What about the Russell mania, the small caps / the debt mania? How leveraged are these small cap companies? Here it is, the Russell 2000 aggregate debt to EBITDA, and we are now in La La Land. We've already topped, and perhaps we will see declines from here. Just like we saw during the last pullbacks in the market, a massive run higher, even though the debt exceeds the EBITDA to the highest ratio ever. But somehow the Russell deserves to be trading higher. This is a clear illustration of the divorce from reality and the extreme mania taking place in the markets today. Even though the game has already changed and you no longer have to be a genius to figure this out. The S&P value now on track for the best month over growth since the year 2000, right before the dot-com bubble bust. Do you need any more warning signals? When the market changes its character, you have to listen. But most market participants, as demonstrated from the trading action today, are totally Clueless. They bought the dip where? In the high momentum names and the tech names that we are seeing smart money being pulled out of. But once again, they're zombies high on meth looking for a score. They're not investors. They're not traders. They're not even gamblers. They see a dip, they go all in, Naruto style, heads first, and then asking questions later, even though the market is already signaling that the investment geography in the market has changed from growth to value. Moving on to corporate-specific news, starting with Lucid Motors. Electric vehicle firm Lucid Motors to go public in an $11.8 billion blank check merger. And we are talking about Churchill Capital. Here it is. Churchill Capital Group plunges 35% after Lucid Motors strikes back deal to go public with a $24 billion valuations. And the donkeys who chased this name higher are all of a sudden caught by surprise. I'm reading their comments and they cannot believe why Churchill Capital stock is down right after they got what they wanted. They've been hyping up this SPAC higher and higher due to the potential of the merger. But once the merger happens, the stock goes down. What's going on here? What's going on here is that you are a bunch of clueless donkeys. You're not an investor, you're not a trader, you're not a gambler, you're just a zombie high on meth looking for the next score. You get your investment advice from somebody in TikTok or Reddit throwing tickers at you, selling you stories and dreams. No attention whatsoever to the fundamentals or the valuations. And what happened is you pushed the valuation of the SPAC to exceed the valuation of the underlying company that is about to merge with Lucid Motors. That's what happened. Math, which I assume that you are not even capable of doing. And here is more illustration of the donkey mentality. Churchill Capital Group stock is a buy despite recent run-up. And this donkey's name is David Modell from Investor Place. And he issued this article on February 22nd. Of course, if you followed his advice, you are now down about 30% or so. And the losses are about to intensify because the fair value of the SPAC is around $15. What about this company? You remember this? Nikola. And Nikola said its long-range fuel cell semi-truck will get as much as 900 miles on a tank of hydrogen when it comes out in 2024, 2025, 2026, or 2030, or 2040, or some years after that. And of course, the magic trick for Nikola trucks is when you are on a downhill, magically the vehicle doesn't need to use any fuel, hydrogen, or any other form. It can magically roll downhill via the new feature of gravity, which is the latest technological advancement humanity is capable of. Lastly, in corporate news, what about Facebook? You know, unlike Google, Zuckerberg played tough with the Australian authorities, saying, you're not going to regulate me. I'm going to take my platform offline, at least the news part, and I'll play tough with you. I will let the population turn against you. And of course, it didn't take long for the Australian government to bow down to Zuckerberg and sign up a deal with him. Moving on to the heat map analysis, and let's see what happened today. Once again, an outperformance from the inflationary trade, massive gains for the energy sector, whether we're talking about ExxonMobil, Chevron, all up over 1%. Meanwhile, my favorite name, British Petroleum, is up over 2.5%. We saw a recovery in PBR, the Brazilian state oil company. We talked about that yesterday. The name is up over 6.5%. And we saw sizable gains for ConocoPhillips, Shell, Phillips, the majority of the energy sector closing in the green. We saw also sizable gains for some sectors of materials, industrials, financials per usual, real estate, certain names such as public storage up over 2%, residential REITs outperforming, but we also saw a comeback from behind for all of the de-inflationary names, whether we're talking about technology or momentum names. So the question is, are we about to play the yo-yo game? Meaning, now that we have pushed the inflationary trade higher, and Papa Jerome eased our concerns regarding inflation, are we about to take some of those profits and rotate them back into technology and momentum names? The answer could happen as soon as tomorrow. But let's check on the themes that we are tracking for the market right now. Theme number one is the reopening trade, aka the nostalgia names. We see gains across the board, whether we're talking about airlines, cruises, hotels, casinos. Once again, we saw another day of gains for the reopening trade. What about the inflationary trade? Gains across the board for the majority of the names. Outperformance from banks, credit services, oil, industrials. But the gains pair in comparison with yesterday. What about the de-inflationary trade? Mixed picture. Some names managed to eke some gains. Some names gained due to individual factors such as Snapchat. And while the picture looks mixed right here, slightly tilted to the red at the beginning of the day, the picture was a bloodbath. Some of these names were down over 10%, but they managed to recover by the end of the day. Some still closing in the red, but some managed to close in the green, such as Peloton, DocuSign, ServiceNow, just by a tiny bit. The question is this the start of something? Meaning that if we reach the conclusion that the inflationary trades have been blown out of proportions, of course, we're not that stupid, but some market participants are, that would mean that we will see flows coming back into the de-inflationary trade of tech and momentum. Moving on to the charts analysis, and let's see what's going on. Starting with a 15-minute chart of the SPY. Gapping lower in the morning, we saw the dip buyers showing up right away, and we saw yet another lower low during the trading day, and that was a signal right there that the bottom we saw in the morning is going to stick, at least for the short term. And from a day trading perspective, that was a buy signal for the SPY. And you saw that the index traded higher all the way to the end of the day, closing the gap. The obvious take here is significant weakness for the index. However, today's activities signaled some strength, specifically in the dip buying appetite, and that is a signal that the bulls are not weakened yet. They are still enthusiastic about this market, and the sell-off the last few days is not scaring the majority of them. Of course, at some point the bull turns into a pig primed for a slaughter. Whether we are at this point or not, that remains to be seen. What about the daily picture, the big one for the S&P 500? And we're talking about the future contract, the continuous chart. We talked about a bull flag formation for days now. And I told you that my line in the sand was the level of 3,875. If we breach that level, then I will start turning bearish against the chart. But we have to close below that level for the day. Would you like to play some games? Because here is the chart playing some games with us. Breaching the support line, going all the way down to where? The trend line in yellow, which happens to be the upper limit of the trading range, and then bouncing higher. Closing where? Closing above the level of 3,862. So yet another twist here to keep us on the edge of our seats. Had the futures contract closed below 3,862, I would have been ready to say that the bearish case won, and we will see further declines here for the S&P 500. But the fact that we managed to close above that level, that keeps the bullish case alive. What brought the bullish case to life? The testimony of Jerome Powell. Shifting to the Nasdaq 15-minute chart. What do we see here? We saw a series of bear flags resulting in the chart trending lower and lower and lower. And the question is, have we caught support this time around from the level of 313? Because one way you could look at the chart is an ABC pattern that was completed today. And the question is, can the ABC pattern be followed by a confirmation tomorrow? That is the question. What you want to see as a bull is a continuation of the surge higher, perhaps closing some of the gaps we left above. What you don't want to see is yet another gap higher, followed by a gap and crap scenario where the Qs start to flush down again. Understand, if we have a gap and crap scenario, that will be the ultimate shorting signal, meaning that we have lower prices to visit before we catch support. And 313 is not strong enough of a support. What if another case happens overnight? We see the Qs gapping lower and opening down in the morning. What you want to see is, as a bull of the Nasdaq, is yet another confirmation of support from the level of 313. What you want to see as a bear is a breach of 313. Tomorrow, it's all about testing the level of 313 for the Qs. Whether the support was good enough today and it will just take us higher from here, or whether it needs to be retested. For more clarity, we're zooming out to the continuous contract of the Nasdaq. We talked about the purple line yesterday, that the target was for a 6.5% correction before we see a bounce. We went a little lower than that. The overall correction right now was about 8%, and it happened in a matter of days. We did not catch support from the purple trend line, but we caught support from the level of 12,766, which I identified as support weeks ago. We will see if this level is sticky or not. The candle formation is showing a lot of strength, closing well above the lows, but it all depends on the confirmation, and this is why tomorrow is a critical day for the Nasdaq. Either you're going to have a confirmation and the next destination will be 13,599, trying to battle that resistance line once again, or you're not going to have a confirmation, you will have a failure once again, and you have to go down to retest 12,766 for support, whether that's going to hold once again or fail. You'll know right away in the morning which direction we're going. What about the IWM? Also gapping lower, catching support in a similar fashion with the Qs and the SPY right after the testimony, however, failing to close the gap. But we are not making any judgment here because we could have just ran out of time. We could give it another shot tomorrow. We did not see a failure of closing the gap and then a reversal. That could happen tomorrow, and that would embolden the bears, but it did not happen yet. Zooming out to the big picture, what do we see here? Once again, tremendous weakness from an RSI perspective, which is supposed to lead us lower, so we can reach some oversold conditions in the IWM, because we have not seen that happen since September of last year. But so far, the series of higher highs and higher lows remain intact. We're seeing weakness, but so long as this series is intact, the leg can continue to go higher. Making a lower low, that would be the death sentence for the IWM. What about the Dixie? What do we see here? Nothing notable today, pretty much closing flat, going up, going down, no conclusion whatsoever. The head and shoulder formation remains intact. What about gold? What do we see here? Gold recapturing the resistance level of 1800, turning it into support successfully. That is a bullish signal for gold, but it is taking a break, waiting on what the US dollar wants to do. Take a look at the MACD. The crossing is imminent now. It's just a matter of time before we start creating green impressions in the histogram. I see the outlook for gold as positive, specifically after the drop and the volatility in Bitcoin prices. And my target here is going back to test the resistance of 1870. Moving on to yields. While the stock market surged higher and we closed well above the lows after Jerome Powell's testimony, the bonds market pretty much stayed neutral. It did not buy what Jerome was selling, at least not today. Trading pretty much flat, slightly in the red, but the trajectory for now remains higher until and unless we see a reversal candle. And that would come hand in hand with an outperformance from the Nasdaq. What about the VIX? What do we see here? Going all the way back, capturing the level of 25, but failing at the end of the day to close above it. Matter of fact, the VIX closed in the red because we saw significant dip buying going on with very minimal resistance. Part of the dip buying was short covering in addition to call options buying. It is not conclusive yet until we hear, or we see rather, a confirmation tomorrow. But the trajectory for the VIX remains positive in my opinion. The saucer bottoming is intact. The crossing in the MACD is imminent, signaling that today was just a warning signal for the VIX to test the waters above 25, going back to get the supplies needed to once again blast higher to travel above the level of 25. What about Apple? What do we see here? 15 minutes perspective. Massive flush lower early in the morning, and we captured support right around the level of 120. And we saw this wedge-ish formation going on. If you are a day trader, that was your sign once you broke above the wedge to buy Apple. And the target was all the way to the gap, which we filled and closed above. So once again, Apple capturing support from 120 and closing above the resistance now support level of 125 and closing the gap. From a 15 minutes perspective, this is a bullish behavior, signaling the beginning of a topping formation. The beginning of a bottoming formation. Whether that's going to stick or not, you have to defend the level of 125 tomorrow. If you see Apple opening lower or failing to capture the support of 125 early in the morning, be ready for lower prices, and perhaps we have not seen the bottom yet. However, if the level of 125 holds, the next destination is 131. And what about the daily chart? What do we see here from the big picture perspective? Massive flush lower after the bear flag formation, and we have now broken the trend, the bullish trend that is, of higher lows. That is over, it's done with, the damage is already done. Don't expect Apple to just go in a V-shaped recovery like nothing happened. The damage is already done, and the top is perhaps here for weeks, if not months, to follow. But in the short term, we have to fix the oversold conditions, and Apple could go higher. But the resistance level is 131. And keep in mind, the 125 has to be defended. Moving on to Tesla, 15 minutes chart. Gapping lower, a massive down day for Tesla, but just like we saw with Apple and the indices, the dip was bought in Tesla. However, we did not close the gap, and that remains the mystery right here. Why couldn't Tesla, with all the momentum it had from dip buyers, to close above the gap? I believe that if we continue to see weakness in Bitcoin overnight, Tesla would continue to trade lower. And once again, assume that we continue to rally higher, that the bottom is here for now, at least for the short term. Where is the next resistance? Right away you see the trend line in yellow, the upper limit of the channel. That will be the resistance. Let's zoom out for more clarity. Here is the daily picture. Once again, my target was 599. We came close, but we did not visit 599 exactly. But the damage is already done. Tesla is down about 30% or so from the top, and we are now at oversold conditions from an RSI perspective. So don't be surprised if you see a bounce for a day or two, at least taking us all the way to retest the trend line, attempting to capture it for support once again. Whether it is a dead cat bounce or not, it does not matter. The big picture remains bearish, not just for Tesla, but for the overall market until we see treasury yields diving lower. The short-term picture, we could be having a bottom for now that take us for a day or two higher, and then we reassess. What about the RKKK? The series of higher lows and higher highs is broken, and now we made a lower low. So the damage has already been done in this chart. The RSI was diverging lower from the beginning, and that was the warning signal. Now it has weakened significantly, and I do believe that the damage is not done yet. We will see more weakness for this name, perhaps going all the way down to my target of visiting the trend line, which will be about 35% correction from the top. We saw massive inflow today. Just take a look at the volume. Massive inflow and dip buying. Why is that? It shows you that the retail crowd is still enthusiastic about dip buying. They see all of these corrections as opportunities to buy. It will all depend on the trajectory of the 10-year treasury yield. And as I showed you, it did not move at all, signaling that it is brushing Jerome Powell's testimony and not taking it seriously. If we continue to see yields trending higher, you will see more declines for ARK. This is my outlook and my take. I do believe that lower prices are here to come for ARK. The dip buyers are falling in a trap. And now let's move on to conclude this video. Once again, as expected, a rescue operation by Jerome Powell by more lies and deceptions. But the trick worked for the day. We saw the dip buyers responding positively to the testimony and pouring back into risk on mode. The question is whether that's going to stick or not. What factors would determine whether that's going to stick or not? Number one, the 10-year treasury yield. How would it respond to the testimony? We have another day tomorrow where Jerome Powell will usher more bullshit out of his mouth. Once the testimony is over, the market will reassess everything and decide whether Jerome is bullshitting or not. So the conclusion is not here yet. You cannot say that the bottom is here, and you cannot say that this is a dead cat bounce until you get a confirmation. And we are not going to get a confirmation until after the testimony is over. But the take here is that the market is waking up to the facts, and you can only kick the can down the road for so long. The inevitable outcome here is that the economy will recover and will overheat in terms of prices and inflation. Meanwhile, we will still have a high number of unemployment. And at some point, the Federal Reserve has to realize that their ability of controlling unemployment by pouring more and more liquidity in the market is backfiring. It is not helping the unemployment picture because the factors determining unemployment are out of their hands. B, pouring more money, hoping that the tsunami of liquidity and more bond purchasing will magically recover unemployment, is only going to contribute to pushing inflation higher and higher and higher. Meaning that the inevitable trajectory from the market is that we will crash and we will have much lower prices from here on. You can sit on the table, play blackjack all night long, get an extension, but the inevitable ending is the house will always win. Because the dealer Jerome Powell is asking us to double down, but he's not offering any insurance. If you want to give us insurance, Mr. Jerome Powell, then announce that you will implement yield curve control. Absent of that, there are no guarantees. You can lie, deceive, manipulate. That will only last for a little while before the same conclusion resumes. The inflation is surging higher. We cannot keep up with it, and we are not ready yet for this high level of inflation before we even step out of the door into reopening the economy. Overheating is the conclusion one way or the other. And perhaps the most important statement that the Federal Reserve Chairman Jerome Powell said today is that we will communicate clearly to the market before we do any bond purchasing tapering. Meaning that Jerome Powell is assuring us that he will tell us ahead of time when the party is going to be over. And that is emboldening market participants to engage in more risk. It is a game of musical chairs, and everybody's comfortable that when the music stops, there will be a chair available for them to sit on. This is what Jerome Powell is saying. But the truth is that there are only few seats available for all the asses in the market. And when the music stops, you will be surprised that some of those chairs have been already taken by insiders, and there are no chairs left to sit on.